Happy Wednesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, March 19th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, is consensus still offsides regarding AI, the Bank of Japan, and the Fed? Our answers are, speaking at the company's annual GTC event in San Jose, California, NVIDIA Chief Executive Officer Jensen Huang disclosed a number of exciting new developments. These announcements coincided with incrementally robust expectations for the AI industry earlier this week. Despite the fanfare, NVIDIA closed down 3% on Tuesday. The stock has declined 14% in 2024 and is down 25% from its January 7th high. The crash in NVIDIA's share price in the face of such positive news reminds investors that tech stocks tend to peak before the best use cases arrive. Elsewhere, the Bank of Japan kept its target rate at 0.5% and signaled it may hike rates as soon as their April 30th and May 1st meeting. The Bank of Japan is currently the only major central bank in the world with a tightening bias. Japanese yen overnight index swaps are currently pricing in 10 basis points of tightening over the next 3 months. That is likely too low and suggests investors are applying a U.S. trade policy discount to the BOJ policy outlook, which we believe is inappropriate at the current juncture. As such, investors should brace for another bout of carry trade unwinding Japanese yen strength over the short to medium term. Lastly, the Federal Reserve is expected to hold interest rates steady at its meeting today. Market participants view the Fed's third mandate through the lens of broad financial stability, and the recent correction in the U.S. stock market has ignited discussions regarding the Fed put. We do not believe reassurance is likely at the March FOMC meeting. In short, the strike price of the Fed put is likely much lower than current risk asset prices. When both the fiscal authority and monetary authority are signaling the strike price of their respective puts is much lower than current risk asset prices, investors would be remiss to disregard such signals. Transitioning to our 42 macro dashboard, as always, we'll wrap up the question from our community. This one's titled Fed Pause on Balance Sheet Runoff and Target Date Fund Rebalancing Positive. A recent Wall Street Journal article says the Fed officials are now contemplating pausing or slowing balance sheet runoff due to concerns about the upcoming debt ceiling deadline in August 2025. It's not, I'll hit pause on that. It looks like 25 billion in treasuries and 35 billion mortgage bonds would be placed instead of rolling off every month. Is this incremental liquidity enough to give market support? This is coupled with target date funds rebalancing, buying equities and selling fixed income at the end of the month. That might give a temporary boost, but not sure how to weigh this relative to all the other bad news out there. It looks like the sentiment surveys are max bearish, typically another contrarian indicator of good buying opportunities, but perhaps bad news is bad news this cycle, given where valuations are. So excellent question. This is sort of a amalgamation of all the questions that I've kind of been getting from our institutional client meetings that I have throughout the week. And so I'll share the short answer. It's there is no right answer. Yes, and so I'll kind of break down each of these kind of in succession and kind of lead you where we've kind of been leading our clients in those meetings in terms of our medium-term outlook for asset markets and the economy. So I'll start with the upcoming August debt ceiling deadline. That's currently kind of the modal outcome projection. When you ask Wall Street, the Treasury recently put out a letter that said June 27th they've recently punted on their initial guidance for June 27th based on tax receipts and things of that nature, those dynamics. And so when we run our analysis, that sort of projects a decline in the TGA adjusted for the amount of extraordinary measures that are remaining in the kitty. I want to say there's about 106 billion left. We kind of get to like early to mid-June in terms of the debt ceiling deadline, not August. Now, it's more likely going to be sometime between early to mid-June and August 31st. I don't think anyone actually knows because we haven't even gone through the full income tax return season yet. So I think we'll have a lot more clarity on the ultimate pace of this process once we get into early May. So we're all kind of just speculating, but I think investors should probably think about, hey, they probably need to get this debt limit lifted in terms of the big beautiful bill that they're going to try to advance the reconciliation program with. They got to get that done, in our opinion, sometime between mid-June and August 31st. We won't be able to be more specific than that, I want to say, until we get past the TGA spike we're likely to see in the second half of April. So in terms of the Fed rolling off, stopping balance sheet runoff, the reason that we've been of the view that they're going to stop balance sheet runoff in the first half of 2025 is for a couple of reasons. One, prior to the debt limit debt limit being breached, prior to the TGA spin down, which is currently artificially inflating bank reserves, we were kind of approaching levels from a bank reserves perspective when you look at it as a ratio of, let's say, GDP or commercial bank assets or commercial bank liabilities, commercial bank deposits. All those ratios were starting to get to levels that were consistent with the stress that we saw in the banking system during the regional banking crisis. And so they were kind of getting close to that signal when they were going to get from the transition from an abundant reserves regime to an ample reserves regime already. Now, what's delaying that now is the drawdown in the TGA, which is inflating bank reserves. And so the Fed has to be concerned that when the debt limit does get lifted and we have this massive spike in the TGA when they start to replenish it, we may crash through those levels in terms of reserves when on the way to the downside. And they're going to, in my opinion, going to want to try to avoid that from a financial stability perspective, because if they do, it's going to have a significant impact on the repo market. And obviously, we know the Fed is hypersensitive to that. So it's our view that they're probably going to stop balance sheet runoff either today, in May, or in June. I don't know which, but in our opinion, they got to do it before the debt limit is lifted and the TGA starts to spike again. So going back to the question, is this incremental liquidity enough to give market support? Yeah, it will give market support. Anytime monetary policy stops tightening or eases policy, which is effectively the same thing from the perspective of asset markets, it will provide support to asset markets. Now, the question is that going to be the start of a durable bull market, or is that a transitory bounce within the context of a bear market? Our belief, and again, it goes back to the, who knows what the right answer is, but our belief is that it's probably likely to be a transitory bounce within the context of a bear market. Now, the transitory bounce already started, right? It started last week, and it's, carrying on here, in our opinion, and it may carry on, right? Imagine if we got to April 2nd, which is the tariff deadline, the reciprocal tariff deadline announcement date, and right before the deadline or right after the deadline, a bunch of countries come in and say, hey, whoa, we're taking our tariffs down. Don't put no tariffs on us. Don't put any tariffs on us. That may be the case. That will be an incrementally positive catalyst for asset markets as well. And so you could get this situation where markets are, kind of down 10, up 7, 8, 9, down another 10, up 6, 7, and kind of this whipsaw dynamic. Because again, what ultimately is happening here is there's this kind of push-pull between the right tail and the left tail. I've been talking on this program and obviously in our published research to our clients about how wide the distribution of probable economic outcomes is. It's not all bearish. We do believe that U.S. growth is likely to slow over the medium term faster than what consensus expects, and that is not even close to being priced in those dynamics. When you look at valuations, estimates for S&P type company sales and earnings, or GDP estimates, none of that stuff is budged materially enough to suggest that we're pricing in a true growth scare. So that, in my opinion, I still think there's left tail risk associated with having to price that in. There's obviously left tail risk associated with having to replenish the TGA as well, but there's also right tail risk associated with potential tariff. The boogeyman that is tariffs maybe gets less at the margins relative to current expectations. You obviously have what has been positive some fiscal support from the perspective of tax cuts and deregulation. The kind of the positive aspects of the Trump agenda. There's some negative aspects of the Trump agenda that are contributing to the faster than expected growth slowdown and faster than expected inflation that we're currently expecting out of our grid model over the medium term. So trying to draw a uniform, linear, straight line to the market destination from here is a fool's errand. What you should do as an investor is expect markets to go down a lot, have these long multi-week, counter trend bounces. So let me tell you what our expectation is. We expect markets to eventually go down a lot. We do also expect, because of the sheer amount of girth associated with the area under the right side of the distribution of probable economic outcomes, the right tail risk there's a lot of right tail risk still there, not the least of which is monetary policy. So you're probably going to have these multi-week periods where markets are rallying, these multi-week periods where markets are declining. And ultimately, we still think the probability of recognizing a crash in 2025 is much higher than the consensus is allowed to believe right now, because they're not doing the kind of research that we're doing to understand the risk of a global refinancing air pocket starting in the second half of this year, or it could be starting as soon as now. I don't want to say, I'm not smart enough to tell you exactly when it starts, but I am smart enough to tell you that the risk is much more elevated than the average person realizes. So that is still a big risk this year. I think that will be exacerbated by a sharper than expected slowdown in U.S. growth, upside surprises in U.S. inflation kind of starting in the second quarter. So there's a lot of left tail risk that has not been priced in. There's a lot of right tail risk that was priced in to some degree. If you think about the hopium and Trump bump that we got after the election. So in my opinion, I think on net, it still favors a bear market over a medium term. However, A, we could be wrong about all of that. And B, that doesn't mean we have to go into bear market territory in a linear straight line. Markets don't go anywhere in a linear straight line. They're going to have counter trend rallies. And so you, Mr. and Mrs. Investor, who's been listening to me rant about this for 10 minutes, you need to make up your mind. What is your goal? Is your goal to be a hedge fund manager or a trader and trade every like 200-300 point in the SPY or 10,000 point dollar move in Bitcoin? Or do you want to get the 1,000 point move in the SPY right, or the $10,000 move in Bitcoin right? Like to me is more important if your goal is to retire on time and comfortably. And that's what our research is designed to do, is to help retail investors retire on time and comfortably, and to help Wall Street portfolio managers and CIOs make fat bonuses. And so we have elements of our research that support the trading activities of the latter cohort of investors, the institutional investors. But if you're a retail investor listening to me talk, if your goal is to try to trade every little wiggle in the stock market, every little wiggle in the crypto market, 42 Macro is not the research provider for you. 42 Macro is very good at making sure you capture the bulk of the uptrend in bull markets and minimizing downside risk in bear markets, and making sure that you actually book those gains when you're at or near the top of bull markets. That's what we do exceptionally well. So hopefully, my long-winded response to this question can sort of elucidate some of the elements that we are deliberating at the current juncture to kind of help clients understand where this is likely all headed. But you also need to realize that we're not going to head anywhere in financial markets, especially in a bear market, because bear markets have more aggressive bounces than bull markets have corrections. Especially in a bear market, you're not going to have a linear straight line to the destination. So just be aware of that. Understand what your goals and objectives are as an investor, and stay true to those goals and objectives. Don't get sucked. If you're a long-term investor trying to retire on time and comfortably, don't get sucked into the top of a multi-week rally in a bear market, in so much that if your goal is to retire on time and comfortably, and I would have said this to you last year, don't start shorting the market too soon because you think you're smarter than the market and you're going to fight, all the flows associated with the raging bull market. So our message is consistent no matter if we're in a bull market or bear market. It's maximize upside capture when you're in the bull market, minimize downside capture when you're in the bear market. And right now, we think we are in the early innings of a bear market. So we'll say, and if we're wrong on that, then our KISS and Dr. Mo signals will tell Darius that you're an idiot and pivot to something that's a little bit more constructive. But again, I'm not expecting that outcome from a fundamental standpoint. So we'll wrap it up there. I know this went a little long-winded today, but it's a great question. Been fielding a lot of the same type of question amongst our institutional client base in our meetings over the past few weeks. So I just want to make sure I had a good opportunity to explain this to our retail clients and the folks following us outside of our paywall. So everyone have a wonderful day. Best of luck out there. We'll catch you back here tomorrow. Cheers.